Hello, listeners. My name is Charles Scott. The program is called Can We Talk? I'm here with my son, Charles Scott.
Junior, how are you guys doing today?
And we're here to give you some information as to what's happening in the mortgage industry and also what's happening in the real estate industry.
Yes.
Every week we talk about a lot of different things that have changed from week to week, and this week is no different. It seems as though things are moving along pretty
Aren't they?
rapidly.
It's already September. It feels like it's still July. August went by very fast.
And also what's happening, the mortgage situation is changed slightly, not radically.
Remember what we heard yesterday? Last week's stat was that in the last 20 years, mortgage rates are low, but the lowest in 20 years, since the year 2000, as far as application goes.
Yes, when he said low, he didn't mean rate.
Oh, no. I mean applications, yes, applications.
Applications. But, now is still a good time to buy. Why is that? Because what's happening is that there's houses that are coming on the market. More and more homes are coming on the market now than were a year ago. So this is helping the first-time home buyers that are out there.
Greatly.
Plus, you don't have all of the big, wars, bidding wars, where everybody's trying to fight over the house and trying to break their neck to get into the house. So this is good. This is a correction. In the stock market, stocks go up, stocks come down, and then they have a correction. And then after the correction, things start going along normally.
Exactly.
And they always say a correction is good. If things go high and high and high to the point where no one can buy anything, that's not good for anyone.
Not at all.
So now what we have coming on is the correction.
And with the correction, like my father said, having correction is going to be good for the first-time home buyers, because the thing is, they can put these applications, let's say they have FHA or something, like they need help with their down payment or their closing costs. What this means is that you'll have less competition, less people going in for these houses, so they have a better chance of obtaining the house.
And segueing into that point, today I wanted to really talk about what you need to do to get ready, or what you need to do to apply for a mortgage.
Yes.
There are certain forms that have to be filled out. When you come to a real estate agency, and after you've gotten your letter to be pre-qualified for a mortgage, then what we do is we take you out, show you all of the different homes, and you decide on a home that you would like to possibly put an offer in on. There's a form called a 4-page standard contract.
Yes.
Now, the 4-page standard contract, that's what I'd say 95% of all real estate agents use.
Correct.
Maybe you could explain to them about what is a 4-page standard contract.
So when you and your realtor are searching for a home, and you find a home that you want to put an offer on, you go back to his office and you'll fill out a 4-page standard contract, which will basically display the terms of the contract and your offer to the house. For example, it'll have the owner's name, or sometimes houses are owned by LLCs or corporations, so I'll have that at the top, have you as the buyer, and basically your terms. How much are you putting down? How much additional deposit are you putting down? Are you requiring an inspection? If you are requiring an inspection, what exactly do you want inspected? For example, a quick example, here in Connecticut, we have a lot of houses that are in the rural areas like Beacon Falls, Bethany, that don't have the water hooked up to the sewer. They have a well. So on that inspection, you may want the inspector to also check the well. So basically, after you have this form filled out and you submit it, if you get an offer accepted, what'll happen is the seller will sign at the bottom, and at that point, you have a basically agreed offer. And then the next step is what my father explained as far as the 1003 form.
Right, and to add to what Charles was saying, that standard form contract has on it about 20 different sections.
Yes.
And as you said, the additional deposit. A lot of people ask, well, when I come in, do I have to put down the entire deposit all at one time? No. You have to put down money just to put the offer in.
Yes.
And it could be as little as $1,000, it could be $5,000, whatever it may be. With an FHA mortgage, you are required to put down 3.5%. That's for FHA. So let's say you're buying a house that's $200,000. So 3.5%, that would be $7,000. Now, you don't have to put the entire amount down all at one time. If you're putting the offer in, you could put maybe $2,000 in just to put the offer. Usually it's 1% earnest of whatever the total asking price is. Now, the offer goes to the seller reviews the offer, and also in that contract you are I'm putting down $2,000 now. If you accept my offer, then I'll put the other $5,000 down. And usually I try to make that after you have an inspection.
Exactly.
Because then you know whether you're moving forward or not. So now what happens is in that contract, as my son said, there's terms in there. You have to put, how long is it going to take for you to get that mortgage approved? So you put on there a date. If you accept my offer, I plan to have my mortgage approved within 60 days or 45 days.
Yes.
And you also put in there how long it will take for you to get your appraisal done, your paperwork into the bank, and have them have an opportunity to review everything.
Exactly.
Usually that's about 30 days. So after 30 days, then what they will do is they will give you what they call a commitment. That means we've now had the inspection, we've had the appraisal. And we've reviewed all your documents, called your employer. So now we can give you a commitment, meaning that everything looks good. Only thing we need now is insurance on the house.
Yes.
The last verification to make sure you're still at your job, and maybe any other paperwork that they may need.
Yes.
So,
I was going to interject there. Now, remember, when you get a pre-approval, they're looking at your, assets, your income, and what money you have in the bank. Remember, that money needs to be in the bank as you approach the closing. And as you approach, your written 1003, you want to make sure that you don't remove any of those funds or pay off any debt, thinking that, it will help you out in the future. It may be detrimental.
very important. Remember, when they check everything, they're going to check to see that you have enough money in the bank
Yes.
to be able to follow through. Once they check, do not go on vacation. Don't spend the money. Don't go loaning it to your friends, your relatives. Keep that money there. It's not free. You're not, free to move forward just because now they've checked that. Because they're going to check it again.
Check again.
Maybe again.
Maybe a third time.
And just before the closing. Because they want to make sure that you have sufficient money in there. And then you do all of your inspections and all of that. So the standard contract, basically, and when I say contract, it is a contract.
Yes.
It's a contract saying that you're going to buy the house and that the seller is going to sell the house to you. So what happens now if down the way your mortgage does not get approved? Well, a standard contract has a provision for that. It states that if your mortgage does not get approved, then the bank will not say move forward. You get your security deposit back.
You get it back.
Or your down payment back.
Yes.
Because it's basically something could have popped up down the road. Maybe they found out that you had more debt because now all of a sudden they found this bill that they
student loans, as we run into some
student
people.
loan, maybe the student loan kicked back in.
Exactly.
Maybe you went out and created another bill and your credit score went down. Maybe you could explain some of the things that can go
For example,
wrong.
like we talked about last week, some people may say, I know I want to buy a house. I'm already got the appraisal done and everything like that. I'm going to go order the furniture now. I'm going to go down, I'm going to finance the furniture. And they tell me I don't have to start paying until 2023. But people don't realize, the moment you walk into that store and gave them your information, they ran your credit. And basically they approved you to be financed for a certain amount. That's going to show up when the bank goes back on this 1003 form. They're going to say, hey, did you buy furniture? We'll say, no, I didn't start paying on it yet. But at that point, you owe that debt. You're committed to that debt to start paying it in January.
That's an additional debt.
Yes.
And the other thing too is this, a lot of times people co-sign for cars.
Yes.
Be very careful when you co-sign. Even if the people pay the bill on time and they're paying, I would advise you, if you have not done so, do not co-sign for anyone for any reason, whether it's a sister, brother, son, daughter, do not co-sign.
Do not co-sign.
And there's a reason why they ask you to co-sign. Usually it's because that person is not credit worthy to do it on their own. And even if the person makes every single payment on time and you co-sign for someone, the problem is now that's considered your debt.
Yes.
Even if you haven't made one single penny. For example, if let's say the car costs $10,000, let's say the monthly payments are $500 a month. Now, you're not making the payments, the other person is making the payments. But what happens is that the other person owes $500, but what happens is the creditor will put down that you owe $500.
Oh, yes. Yes.
Why? Because they're looking at the worst case situation. If the other person doesn't pay, you are obligated to pay. So they make sure that if that happens, you can not only pay for their bill, but also your bills at the same time.
Exactly. Some people may think, well, they think the bank would understand that I co-sign for, let's say someone co-signs for their son or daughter to buy a car, but the son and daughter are working, they're paying it. The bank doesn't see that. The bank says that it's on your credit. So they're going to say that's your responsibility, even if the son is paying it. So be careful when it comes to co-signing. It can affect your mortgage in the future.
And if you've already co-signed and that's a situation, here's a way in which it can alleviate it a little bit. Make sure that the person who you co-signed for makes all of the payments from their bank account.
Yes, yes. We've seen that very recently. They give the money to the parent, and then the parent pays for it. But they'll say, oh, well, I got the money from my kid. The bank doesn't see it. The bank sees it coming out of your account. So they're saying you're paying for it.
So make sure and keep a record, keep a paper trail.
Yes, keep a paper trail. Very
so
important.
that you can see where that money's coming from. I know you can talk about a couple of situations where, like you said, why don't you elaborate on a little bit, because that's very important.
Yes, yes, most definitely. So as far as when it goes to that, when you have a mortgage or you're applying for a mortgage with this 1003, they're going to go through everything again. They're going to see, have you taken out any new loans for a car, furniture? And some people may say, that money I saved up for the closing costs, I'm going to use that to pay off some debt and then put the money right back. Don't do that, because they're going to say, where did that money go? Why are you paying this off? Why are you paying more than the minimum payment? When you get pre-approved, you want to make sure that everything is still intact when you have the offer accepted. Because some people may say, well, I'm pre-approved in April. We didn't find a house until July. And since then, I needed to use that money for certain emergencies. Remember, that money needs to be in there, because when it's time to close, you have closing costs to pay.
We have that situation occurring right now.
Yes.
This is a woman who's buying a house, and when she got pre-approved, she had the money in her account, all of the money plus some money. Now what happens is that when she goes back to fill out the final application,
The 1003 form.
the 1003 form, the mortgage person says, okay, this is how much money we're going to need. We're going to need a total of like $18,000. Oh, I don't have all of that. Well, you had it when we started, or I would not have given you a pre-approval in the first
Exactly.
place. What happened? Oh, this came up, that came up, and, as I explained before, I can get the money because my brother's willing to help me out and my sister's willing to help me out. So therefore, as I knew how much money I needed, and that's not going to be a problem. So she thought.
So she thought.
So now she goes to the brother, and the brother says, oh, sure, I have the money. I have, money that I just put into my bank account. Now it goes back to the banker and says, okay, I have my brother, he's willing to loan me. Oh, no, can't be a loan.
Can't be a loan.
Got to be a gift.
Gift.
In other words, you cannot borrow money from someone else to pay for a house. It's like robbing Peter and paying
pay
Paul.
Paul.
So now
Can't do that.
That's considered debt. It's got to be a gift. So
And
not
that
only
must be
does
in
it
writing,
it's
correct?
got to be in writing. You got to get a letter saying I'm giving my sister a gift.
Gift.
And the money has to be there. Now, not only does the money have to be there, the money must have been there for 2 months.
Yes, yes.
Can't
very
just
important.
be put there.
As we've been learning over the years, the money cannot be under the mattress of your grandmother just waiting to be put in the bank account. That money must sit there for 2 months, because the bank is going to say, where did that money just miraculously come from? They want to know that the money's been in there and that it come from a reputable source.
Not only that, the person I almost said the word borrow.
Oh.
The person
Gift.
you're getting the gift from or the money from to help you buy the house, they want to see the bank account from that person.
Yes.
Say you're getting the money from your brother. They want to see his bank statement, and they want to see how much money was in that bank statement for the last couple of months. And if the money's already been there, that's okay. But what if that money was just put there within the last month?
Exactly.
That won't work. Why? Because they want to make sure that the brother didn't go borrow the money to give to you. So how could they say it's a gift when somebody's got to pay it back?
Exactly.
And the bank knows that you are the one that's going to be paying it back. So now they're saying, do you have enough money to buy the house and still pay other people's debt at the same time? So if you borrow the money, it has to be from a situation of where that person has the money, it's been there, and then if you're going to get a gift, it has to come in the form of a gift letter. It can't be borrowed.
Definitely a
So
letter.
that's
And
it.
you got to hope the person has a bank account too. Some people say, "Oh, my uncle doesn't have a bank account. He deals with cash." Well, that's not someone you should be getting a gift from.
That won't work either.
That will not work.
That won't work either. So then what she did is she said, well, what about the sister? Well, okay, the sister, same situation. So now the money that was going to be there, all of a sudden the money's not there. Luckily, we're able to salvage the sale because one thing she didn't realize is she's got a 401k.
There you go. And we should talk more about that. People don't realize that.
People don't realize that. When you have a 401k, you can get money from your 401k to buy a house.
Yes.
Yes. And the thing about it is it's sort of reverse of what we just said, because on the 401k it says you can take out a loan. So but remember, who are you borrowing the money from? Yourself.
There you go.
So it's really not a loan, it's a loan from the 401k
Exactly.
contribution, but it's your money anyway. So in the 401k, the reason why they say it's a loan is because you don't pay taxes on the money.
Exactly.
Because the money is growing in there. So when you take the money out, you agree to pay the money back. But if you don't pay the money back, then what happens is you are actually just taking money out of your 401k, and it won't be as much in there when you retire. Now, when you're taking money out of a 401k, you still have to pay tax on the money. However, if you take the money out, and I'm not an accountant, I'm not an IRS person, but usually there's 4 reasons that you can take money out of a 401k and not get penalized.
Exactly.
One, if you lose your job and you're unemployed, you can take money out to help you with your unemployment. Number 2, you could take money out for an education. In other words, if your child is going to college, you could take money out, use it for education. Number 3, if you're sick and disability. And 4, if you take money out for a house.
Very true.
So you can take money out from your 401k and use it for a house. Look at it this way. If your 401k is giving you an interest rate of, let's say, 3%, and if you are able to put money into a house, and the house in the long run, if things go up, gives you 10%, so you're still accomplishing the same purpose.
Exactly.
Only as you're actually doing better off taking the 401k out of your retirement, putting it into the house, because the house is still going to go up in value normally, in other words.
Very true.
You have to sit down with your accountant and figure it out.
I was interject. What do we see these articles over the past few years? Some people say, my house earned more than me. As far as people making $100,000 a year, but the house sitting there is appreciating in value. So some people may say that their money is working for them better in the house versus the 401k.
So as you can see, there's ways of doing things. And like I tell everybody, make sure you stay in touch with your mortgage person.
Yes.
Because that's the key. Once you're applying for a mortgage, do not just assume things. Don't go off on your own saying, oh, I got the letter, I got the house, they're going to sell me the house, I'm all set, let me get some furniture, oh, let me celebrate, let's go on vacation, let's do this, let's do that.
Before the closing.
All before the closing. Because the bank, and this particular woman was like, oh, I'm glad I talked to you. Now I understand how this really works. And I didn't realize they were going to be checking all of these different things. I said, they're going to get that bank statement from you, and they're going to look at every item on there to see where your money went.
Where'd it go? Where'd it come from?
And if you put any money into your savings or bank, and it's over $500, they're going to want to know, where did that money come from? So you're going to have to explain in a written letter, or show them where the withdrawal came from another account to go into that account. All of this is required because they don't want you to get in trouble going out there borrowing all this money
Exactly.
to buy a house, and then you owe everybody. Everybody's coming after you. So
That's what I was going to say. So people see this is part of how this upcoming, as they say, call it a recession, is going to be different this time. As far as 2008 was a totally different story. With the housing, people are more qualified. These homeowners this time around are more qualified to buy the houses. As you see, the banks check everything now. And they'll check the bank account of where you're getting the gift from, too. So as we see, you want to have an experienced realtor, someone that knows all these things as far as when you're making your choice down the line.
because what happens is that you get into this situation and you have no guidance, and you just start making decisions on your own. And usually those are not the best decisions.
When people see today, you see a lot of commercials. You see, for example, I heard of a company that recently got into trouble, LoanDepot.com. It's just these companies offer quick qualifications, quick referrals, but they don't give you a face-to-face person. We tell everybody to go to your local loan officer or someone you have a relationship with, as far as your bank that you bank with now, and start talking to them and see what you can do as far as getting pre-approved.
Now, the other thing is that I started off today by saying this form here.
Yes, 1003.
This is called a 1003. What is a 1003? Once you have gone out and gotten a house and identified a house that you want to put an offer in on, then the seller will accept your offer and you have a contract. And then you do your inspections and you have to apply for the mortgage itself. Remember, the bank gives you a letter stating that you are pre-approved or pre-qualified. That letter states that you now can go out and look for a house.
Yes.
Once you actually find a house, that's not it. You just don't sit back, because how does the bank know that you found a house? You have to have a lawyer to represent you. How do they know you found a house? So how that works is now you have a contract between you and the seller. That contract is sent to the lawyer. The lawyer looks at the contract, looks at the terms and everything, and knows that you're supposed to have a mortgage by a certain date. So the clock starts ticking.
Yes.
Now you go sit down with your mortgage person who gave you that pre-approval or the pre-qualification, gave you the letter, and you fill out an application to buy the house, to buy the actual house. Because when they give you that letter to go out and look for a house, they don't know what house you're going to buy. They don't have a clue what area it's in.
The taxes.
Well, they have sort of an idea of the taxes, because you give them that before you actually put the offer in, so you make sure it's within their guidelines. But now you've got to actually sit down and fill out the application for your mortgage. And that form, most mortgage companies use, it's called a 1003.
1003.
Now, what's that? On this application, you can see the amount of pages. It's not all that complicated. I'd say it's probably about, probably 6 pages.
6 pages.
6 pages. What's some of the information that is going to be required of you? Because people always say to me, how do I get a mortgage? How complicated is it? What is it that I have to do? This is the paper that they use. This is what they go by. And on that paper, just to give you an idea of some of the things that they would be asking you, they're going to be asking you, naturally, where the property is located. Subject properties there. Also, legal description.
Yes.
Is it a 1-family? Is it a 2-family? Also, they're going to ask you on here the year that you acquired the pre-approval, which they already have a copy of. They're going to want to see that. And they're going to see down here how much is your down payment.
Yes.
It says on here, source of the down payment.
There we go.
So they want to know the source of the down payment. Now the borrower's information. They're going to want to know the name of the borrower. Now if there's a co-borrower, maybe it's a husband and a wife. Maybe it's 2 brothers, 2 cousins. And then they'll want to know the social security number. And this one used to be years ago, he used to trip everybody up. It says home phone number. And years ago, that used to count against you, because if you didn't have a home phone, they'd say, how are we going to get a hold of you? How are we going to contact you? That's with cell phones. I go way back.
That was before the cell phone. Say, how do we get a hold of you?
When cell
I mean, I have a home phone.
Right. When cell phones are just coming in, And the people would say, well, I don't have a home phone. The banker would look at you like, oh, this person's not reliable. They don't even have a phone in their
The
house.
equivalent for today is the email. You got to have an email. Most
Email.
definitely. Everything's paperless now.
So now it's like cell phone. What is your, for both parties.
Exactly.
Then they want to know, married, a single, how many dependents, and your present address, and your mailing address, because it could be two different addresses.
Or it could be a P.O. box.
Could be a P.O. box. People use a P.O. box. So all of these things. Then it states here employment information.
Correct.
They're going to want to know the name and the address of your employer, how many years on the job, if you're self-employed, and in other words, basically what type of occupation is it? Because sometimes you may have changed jobs, but if it's okay if it's the same type of work.
Same industry, yes.
Right, so they want to know that. The position, what's your title? Who's the manager? Who's the boss? Who's the contact person at your job? The name and the address of the employer. So then they want to know monthly income and combined housing expense. So you give an idea of what's your monthly income, what's your housing expense. Do you get any overtime, any bonuses, any commissions, and your net rental income? How much rent are you paying now? These are the questions that are going to be asked of you when you go to actually apply for a mortgage. Now, if you're self-employed, they're going to want to see your tax returns. Usually it's 2 years of tax returns that they're going to. And then if you're buying a house in July and let's say the year started in January, you have to show them how much money you made for that year.
Okay.
So then also any liabilities. That's where they check your credit report and see
Yes.
all the bills that you owe.
Any new bills also.
Or any new bills. So mainly it's not all that complicated, as you can see. This is called a 1003.
Yes.
So from that they can get a history of everything.
Exactly. And as our series continues, we're going to go over more of the forms that you're going to encounter when you're going to buy a house. Most people may be vague on what forms they have to fill out.
Exactly. Because these are the things that have to be done. We try to make this program informative where you can see it's not all that complicated if you know the rules.
Exactly.
These are the rules.
You want to make it transparent as possible, help the people out.
These are the rules. This is what you have to do. So it's not all of that complicated. And if you're not ready now, we'll help you get ready.
Exactly. Tri-State Realty is here to help, and please continue to like and subscribe and watch us every week. Thank you very much.
Okay, until next week, God bless.
Amen.